All right. Hey, welcome back to the Confident Retirement Podcast brought to you by LPF Advisors. I'm your host here, Kris. Today, we're diving into some changes that could impact anyone who has inherited an IRA or is expecting to inherit one in the future. The new rules have caused quite a bit of confusion since the Secure Act was passed. And there were some follow-up regulations that clarified a few things, but also added some new twists and layers. So joining me today, my co-host, the resident CFP Collin, here to help us break it all down and figure it all out. First, our disclaimer: the information we provide is our opinion and not necessarily that of our firm or this platform. We provide general information only on the podcast, not any customized investment advice. Nothing should be construed as financial, tax, or otherwise. You should consult your own professionals on your personal situation. Collin?
Yes, sir. So today we're talking about inherited IRAs. So as we know, the Secure Act changed things around a bit, and the IRS doesn't like to make things any easier on us. So there's a lot of rules that we can go over today.
Yeah.
So let's get started. Kris, what are some of the new rules for the inherited IRAs?
Okay, so the biggest change comes from the Secure Act of 19 and the follow-up Secure Act 2.0. Usually when you have a 2.0, that means it's supposed to be better, which was in 2022. The main difference is the introduction of the 10-year rule. So now most non-spouse beneficiaries are required to withdraw the entire balance in an inherited IRA within 10 years of the original owner's death.
Mm-hmm. So does that mean that all beneficiaries have to take money out during those 10 years?
Well, it doesn't necessarily mean you have to take it out every year. It depends. If the original account holder had already started taking what are called required minimum distributions, or RMDs, before they pass away, then the beneficiary must continue taking annual RMDs for the first 9 years. Then in year 10, the entire remaining balance must be taken out. But if the original owner had not started RMDs yet, then technically the beneficiary is not required to take any withdrawals until the end of the 10th year, but they still have to empty the entire account by the end of that 10 year. Waiting until the final year obviously could lead to a huge tax bill, especially if the money's grown. So it's something to consider carefully, and you have to do some planning.
Absolutely. So it sounds like they made it a little bit trickier for us,
Of course.
naturally. So who exactly falls under these 10-year rules? And are there any exceptions to the beneficiaries of these rules?
Yeah, so that's a good question. The 10-year rule applies to most non-spouse beneficiaries. So it doesn't apply to spousal beneficiaries. It's non-spouse beneficiaries, adult children, siblings, and others who don't meet certain criteria, exceptions, which we can't go into today. However, there are some exceptions for eligible designated beneficiaries, which include, I mentioned, spouses, minor children of the account owner until they reach the age of majority. If someone is disabled or chronically ill, who's a beneficiary, or beneficiaries who are not more than 10 years younger than the deceased account owner. So these eligible beneficiaries can still stretch the distributions over their lifetime, but once a minor, as I mentioned, reaches the age of majority, they must flip over to the 10-year rule.
Right. That makes sense. So, with these new rules in place, what should beneficiaries be thinking about in terms of their own planning?
Well, tax planning is definitely the biggest thing and is more important than ever. So one approach that we can commonly recommend is to spread out the distributions over the 10-year period instead of waiting until the very last year. This can help manage the taxable income and avoid being pushed into a higher bracket by having to take all the money out by the end of the 10th year. Another strategy could be considering Roth conversions while the original account owner is still alive. This doesn't apply if the original account owner died. Since Roth IRAs don't have RMDs during the account owner's life, they can do the conversions, that money can grow tax-free, and beneficiaries won't owe taxes on the distributions what they have once they have to take them. The 10-year rule still applies, but if it's in a Roth IRA, then it wouldn't be taxable. Roth still needs to be emptied within the 10 years. This would have a zero tax burden for the beneficiaries.
Got it. So if someone recently inherited an IRA, what should they do first? What's that first step for them?
Okay, so first you need to determine which type of beneficiary you are. Are you a spouse or a minor child or a non-eligible designated beneficiary, a non-spouse beneficiary? So that will dictate what your options are. Then you can consult with your tax professional or financial advisor as soon as possible to get a distribution strategy together that hopefully minimizes the impact that taxes are going to have, and to ensure that you comply with all these new rules.
All these fun new rules. Awesome. Awesome. Well, that's good advice. And it sounds like there's a lot of planning that needs to happen, but that planning can make a huge difference down the road, Kris. So I appreciate you breaking that down for us. And if there's any listeners that have more questions about the new inherited IRA rules, feel free to reach out to us at lpfadvisors.com or email us using info@lpfadvisors.com, and be sure to subscribe and share this podcast if you found it helpful. And as always, thanks for tuning in to the Confident Retirement Podcast. We'll see you next time. And until then, take care and be well.
You've been listening to the Confident Retirement Podcast with Kris and Mark from LPF Advisors. For more information on them and retiring confidently, please visit lpfadvisors.com. If your ears are pleased and your mind is now at ease, do share the program with your friends and subscribe wherever podcasts are found.